What's up, everyone? I'm hoping you're good. I'm good too. And today we are talking about gold. And again, we're using the Elliot Waves theory to predict the price movement over time. Um, I'm just gonna open the analysis we made on gold, predicting this entire move to the downside. As you can see, this is 4-hour time frame, and it was maybe like over here when we said it should fall for maybe for this depth, and it actually did. So I mean, it was this analysis. When it was like over here, and we said that. I mean, like, there are previous videos about this anyways in this channel, and the background sound, explanation just muted. So you only going to be seeing an analysis, but if you having the little understanding about the Elliot waves, or maybe you just do understand them, you will understand what was actually going on, what I was trying to say and predict in that previous video. But I'm just gonna explain everything right now in this video, and you will get to understand it. So we were like over here, this is wave 4, and we wanted to finish this entire cycle because it is complete when it's having 5 waves. So I was like, when I opened this chart, at first I questioned myself, where are we with cycling? Where are we? Where we currently at? What are we making? Is 4 or a 5? So I was like, okay, I counted my waves from the beginning. It was like 1, 2, 3, and then 4. Okay, we are actually making a 4, and we're about to complete it. So I then applied the Elliot wave rules, and I based everything with the Fibonacci because we used the Fibonacci to find the price trends, like this 10 over here and this 10, the very significant 10 in the entire cycle, where we can place the trades, the most safe trades, and then expect the price to move according to the analysis. So we wanted it to fall to make the 5 completely. So let's check it out. As you can see, it's actually completed the analysis. It's completed the analysis because it can just continuously extend itself downwards. But there would be a win-win for us because this is where we took the entry, the bearish entry, and then we need it to fall. The only thing we're doing is to trade stop losses. And yeah, stop losses, we just trail them, up until, they just take you out when it tries to, go the opposite direction, because each and every time when the waves complete, when you have your full entire 5 waves, you want to expect the correction to the opposite side, opposing the actual cycling, an ABC correction sort of a structure. So let's actually talk about the rules. The first thing that is important is to know the rules and know the basic structure. Let me just show this. So as you know, you have 5 waves, and this is how they look when they act. These are bullish waves, and let's have some bearish waves over here. These are bearish waves. These are bearish waves. 1, 2, 3, 4, 5. Right. Okay, let's change the color so this one's to be red. So over here we have a structure of the market when it is bullish and when it is bearish. It's just the same thing, just the same rules we're applying. 1, 2, 3, 4, 5, and then we use the Fibonacci to find the depth of these corrections, because in the full cycling there are 2 corrections and 3 impulsive waves. This is 1 with 1 impulsively, with 3 impulsively, and then with 5 completing the cycling impulsively. But you notice that this move against the trend, so there are corrections in the market. There are corrections. So let's take a look at you know, when we're trying to find the depth of wave two, when we're trying to find the depth of where can it terminate the corrections, what is actually going to be stressing about. We predict where the corrections will be, and then we predict their decrease and the amount of time they're going to take to actually terminate. Those are the things we're going to be stressing about using the Fibonacci levels. The Fibonacci price extension is trend-based Fib extension, and then this one is based on time, and then these are time zones. So let's talk about the percentages when we use the Fibonacci retracement, because when we talk about the corrections is when we're talking about the retracements. So we're gonna use the Fibonacci retracement, and the trend starts here, and then 1 terminates over here, and then we get to a correcting phase. So we're just gonna put our Fibonacci over here, and then at the top of 1 over here, and then try to find the termination point for wave 2, right? But in most cases, it terminates at 60%, 61.8%, because this percentage is the golden ratio. Is the golden ratio. Many people who use Fibonacci, in many times they actually use 61.8%, but it can also terminate at 50%. This is still acceptable as wave 2. It is still acceptable. So acceptable percentages, they started with at 50%, and then they can take 60% or 78%, any of these percentages, but at least it must retrace from 1 up to 50%. And then you can start that naming it as 2, right? So next time we're going to find it over here, still 2, 61% in main, usually it turns here, but can also turn over here, can also turn over here. So wave 2 started 50%. That is the rule when you're trying to find wave 2. And then when you have to write wave 3, you know that it is the longest wave, as you can see the structure. It is the longest wave in the market, so it needs to be longer than each and every one. So we'll be having wave 1 currently. So we're gonna take its length and then try to project it like this, so we can find its length. Let me use this line. It's terminated over, the 100% length of wave 1 is this price, is at this price. So you know that you have to move beyond this line. First of all, you need to move beyond this price, because wave 3 is the longest of them all. It's the longest of them all, but do not stress about this. You just know that wave 3 is the longest, so it goes on and on and on. If it's 10 here, it's still wave 3, because it is just beyond this price we were talking about here. It is just beyond it, because it is now longer than wave 1. So you meet the first rule, the second rule, because the first rule is that wave 2 terminates, acceptable prices. We start counting wave 2 at 50% or at 60 or 78. So with rule 2, wave 3 is longer than each and every wave. So when you write wave 3, when you write it, and then it's going to show the sign of weakening, because it cannot just keep rising. It's going to show weakening signs. When it tries to retrace, maybe you find it at this point when you open your charts and be like, okay, we're not retracing, okay. And then you'll be like, we'll take your Fibonacci and then try to find the termination of wave 4, because it's a correction. We use Fibonacci retracement tool, and then you start to go beyond the graphs, and then because maybe it will be over here when you open charts, and then you'll be like, okay, where are the supports where we actually bounce off and then continue with the cycle, because we need to complete it with 5 waves, right? So you'll be like, okay, first of all, the rule, another rule says that acceptable percentages for wave 4 starts at 23%. You can name it as wave 4 if it turns here up to that point, or if it turns here, this is the last line of support for wave 4. So nothing beyond this is not wave 4, right? For now, because sometimes it just moves beyond it and then continues up. So for now, let's just say this is the last support line, because those are the basic rules for wave 4. So if it terminates at 4, you'll be like, okay, maybe putting your buy stop here when it's over here, getting close and close to this line, and then your stop loss maybe over. I don't know how you put your stop losses anyways. So it's going to be your risk management. So when it tries to terminate here, you'll be there, and then you put your buys here, put your buys, and then you start to watch it going higher and higher and higher. And then you know that wave, the length of wave, because when you finish the cycle, you need to know where it's actually terminates, so that you will not, have some drawdowns when you're not there. When it terminates, and then comes back to your positions without you closing. So it is better if you put some TPs, if you put some TPs where you think it's going to make a 10, right? So you know that wave 5, the length of wave 5, the minimum length required for wave 5 actually it must be equal to the wavelength of 1, the wavelength of 1. So in this case, we will be targeting these prices over here and saying, okay, over here we're making a 10, because the minimum length required for wave 5 is this one, equaling it to wavelength of 1. So just that is. And then after a full cycle, what comes after a full cycle is an ABC correction. And then we take our tool and then just name it an ABC correction. And it needs to be visible to your eyes before you interact with it, because you cannot just take this pool and be like, okay, now I want it to go higher again, because each and every time when it completes an ABC pattern, it resumes the trend, continues with its motive trend as 1, 2, 3, 4, 5. These are motive waves. They are bullish. So after that, we need a correction, and then we continue with the trend, right? So you know that after the completion of these ABC pattern, you need to resume the trend. So this needs to be visible before you buy again over here. After finishing the cycle, if you want to put your buys over here, you need it to be in this form, visibly to your eyes before interacting with it. You do not just, because this can just be like over here, right? And you feel like this depth is enough now to go back higher and higher and higher again. But because it came at this price, pushing down like this, like a falling knife, you cannot just interact with it, as it will go up and then try to come back down, because each and every time it gives you an ABC structure before it takes off, before, or if it's right, it's going to give you an ABC, and then you wanna fall with it. Let me actually draw this. Before we wanna continue following with this bearish trend, you need an ABC type of a structure. You need an ABC type of a structure before you continue with the bearish trend, right? So let's try to check this. Let's try to check this in an actual chart. How it deals with gold is actually the same way as I've explained the example above. So first of all, I told you the first thing you need to do is to actually realize where you at with the trend. So if it is the first time you open this is gold, you would be like, okay, 1, 2, 3, 4, 5, already you made your 5 waves. So you just need to wait for an ABC type of structure before you resume the bearish trend. This is actually what is going on. So let's name it. Let's number our waves. 1, 2, 3, 4, 5, right? 1, 2, 3, 4, 5. And wave two must retrace at least to 50% or 60% or 78%, right? So let's take this Fibonacci tool and then put it down here where it ended. Started over here, and then wave 1 ended over here and showed weakening sign going up again. And then you try to predict the termination point for this correction. And once again, before you interact with the correction, thinking now it is complete, you need it to be in the form of an ABC. But for now, let's get to the termination point. So it went up this far, almost got to 50% to 60%, but just some small some small pips to this price, just some small inches there to reach that price. But again, it is now acceptable, this price, because already it is like surpassed 50%, the acceptable first percentages, right? So our wave 2 here was nice and clean, You would have targeted to make your entry over here, and then you first need to meet another second rule that says that wave 3 must be longer than each and every wave. So already you have wave 1, and then you're like, okay, let me find the length of wave 1 and try to project it. And it started over here, and then anything beyond this price, you can take it as wave 3. Anything beyond this price, you can take it as wave 3, because it needs to go beyond the length of wave 1. Just remove this, and then now anything beyond this price, you can name it wave 3. As you can see, we had our wave 3 below this line, right? So and again, okay, here you would have like let the price retrace, like just for now, do not try to project 3 exactly where can you be. Do not, because it would have like retraced down here. It would have gone like this. Maybe if when it surpasses this line, maybe just go at this point then before it goes up. So it would have been still wave 3 even if it was down here. So we do not stress about wave 3 for now. The only thing you need to do is to realize that this is like enough to call it a correction. It is maybe if you open your charts and you find out the graph is already at this point, right? Retracing from this point. So you're like, okay, you are retracing here. This price must be significant or something. And then you take and then you'll be like, if it retraces at these prices where your 4 can be, this is what you do when it retraces. If you say this is 3, and then you will be like, okay, and then I'm putting my Fibonacci here and try to find the actual wave length of 4, the termination point, and then your last support, it is at 8.3. But again, this one a little went beyond it, but as you can see, it first reacted and then came back. It held several times. So this price is significant because it aligns itself with that 8.2%, right? And then this is how we predicted wave 4. Okay, let me remove this line, and then this one. This is how we predicted wave 4, that this graph must not move beyond these lines, must not actually come to 50% over there. So we were like, okay. We thought of another rule. I almost omitted this. And then we put this line over here. This is where 1 ended, right? This price. So that when this retrace is trying to find 4, now you're trying to find the point where 4 can turn, right? But it cannot reach this. 4 does not touch the price 10 of 1. It must. This is why we were like, this is the invalidation line. Invalidation line. This is why we put this text over here declaring this line as the invalidation line, because if these candles over here went on to touch this line, the entire cycle would have been invalidated. The entire cycle would this would have been the wrong count. So whatever happens, I was like, it must not touch this top of line. This line must not touch it because it invalidates it. It vandalizes the Elliot's rules that says wave 4 must not touch wave 1. And I was ready to do this because you also know that the trend line gets validated when at least it gets touched 2 times, and then the third time it will find its resistances and then continue with whatever it's trying to do. So I was okay to do this, and it held, very much. I had this one. It held as the expanding triangle. So as you can see that it did not, though it went above 38.3 here a little bit, but right now the only thing left to do is to predict the wavelength of 5, right? From 4 to 5. And then again, the minimum length required for wave 5 is must be equal to the wavelength of 1, right? So we're gonna clone this, then find this length, take it down over here where 4 started over there, right? Started over here, and then we need this length. As you can see, it's still going down so that it can cover the full length before it actually goes up. Now you realize how it is reaching this point, some kind of price correcting itself downward, so it can push a little bit higher. After it touches there, it is already reacting as people are exiting their trades around these prices, because the cycle is actually getting complete. So what we need to be waiting for is an APC, structure, is an APC to the opposite direction. I don't know where, but we're still going to learn that. I don't want to put in a lot of things into your mind for now, though you're capable of just not now. For now, we need to focus on the basic structure. This is how we dealt with gold, and like the trades were successful that we took were actually successful. So these are the Elliot Waves, everybody. We're going to meet on another video. Thank you.